hear, we see commercials on reverse mortgages. I have people that are self-employed that are wondering if they can get a mortgage, people that are new to the country, if they're qualified. So can you talk a little bit about some of the different types of mortgages that are available to buyers?
So as long as you're within that 680, really 650 to 900 range, you're going to be getting premium mortgage products across the board. And if you have bruised credit, it's important to identify what's ruining your credit.
Buyers, I know, whenever they're going out to purchase a home, they're always looking for that good deal. And, we've talked a little bit about it, that the first thing they think about is the rate. What rate are you going to give me? But I know, as I'm sure you do, that not all mortgages are created equal. Welcome to Realty Bytes, conversations on real estate and lifestyle, the podcast that empowers you to make informed decisions about your real estate investments and create your dream lifestyle. Join me, your host, Evelyn Lopes, and industry experts each week for timely insights, tips, and tools to navigate the complex world of real estate. From market trends and financing to savvy investments, design, and decor, we cover everything you need to secure the home you've always wanted. Join us on Realty Bytes conversations and embark on an exciting journey towards a better home and a better lifestyle. Are you confused by all the mortgage terms? Are you overwhelmed by the mortgage process and don't know where to start? Are you looking for tips on how to make the most of your mortgage? Then this podcast is for you. In this episode, we'll discuss the fundamentals of mortgages, including decoding the mortgage jargon, reviewing what types of mortgages are available, how to choose the best one for your needs, and how to get the best deal. We'll also provide practical tips on how to save money when applying for a mortgage. Tune in to learn all about the fundamentals of mortgages with Walid Mutahar, mortgage agent with Garland Mortgages, and today's special guest. And to make sure you know how to get the best deal when negotiating your next mortgage. So good morning. Today we have a really special guest who is Walid Mutahar. And Walid is a mortgage agent with Garland Mortgages, and Garland Mortgages is a division of Get a Better Mortgage and the Mortgage Center of Canada. And Walid has been kind enough to give of his time this morning, so welcome. There's so many people out there who are looking to either buy or sell real estate, and they have a lot of questions, and a lot of those questions surround mortgages. So I thought today we could spend a little bit of time talking about some of the fundamentals that are involved when a person is looking to get a mortgage or change a mortgage. And I'm sure that our listeners out there will learn something new and hopefully will help them as they move forward with their plans.
For sure. It's definitely been an interesting time over the last years. I'm sure a lot of people have heard. So let's get to it.
Okay. And so why don't you give us a little synopsis of kind of what's happened over the past year and where you think mortgages are going this year?
Yeah, so I don't think it's any surprise to any of our listeners what's been happening in terms of prices. In terms of 2021, we saw rates basically bottom out, getting very close to zero. And so prices started to skyrocket. Everybody wants to get into the market, lock in a rate at virtually 0% and hold on to that for as long as they could. Now, 2022 came around and things started to take a turn for the worse. Around March or April, rates started to slowly creep up based on the inflation numbers. The Bank of Canada felt it was necessary to increase their prime interest rate or key interest rate, which then in turn affects the prime lending rate across all banks. So we saw rates go from 1 to 2% to now around 6.5%. And of course, that's had an impact on the prices in housing market. So in terms of
affordability as well, right?
And affordability, absolutely. So looking forward, everybody's kind of the sentiment around the market is that rates will start to creep back down in around 2 years' time. But there's no guarantee. Nobody has a crystal ball. And it really depends on where the inflation stands. The Bank of Canada has made it clear they're going to keep increasing rates until we get inflation down.
Mm-hmm. And Do you think that those rates are going to go where they were during the pandemic, or was that kind of like a very special circumstance that we probably won't see again?
Probably a very special circumstance. It's very unlikely. I don't think it's ever been done in history where rates were, 0.99 some lenders were offering. I just don't see that happening again. Probably the sweet spot is around 3.5%. That's going to be kind of the medium.
Right. And when I think about my career helping families in real estate, which is extended over 30 years, 3.5% seems like a really good price. When I first started, rates were around 21%. So what is the average rate that the Canadians have seen in terms of mortgages, say, for the past 25 years? Would you know offhand?
Average rate, I wouldn't know the exact number. I would estimate it to be somewhere around, 5 or 6% though. Like you said, back in the early 2000s, we were seeing rates come down from close to 11%. They got down to around 2%, then dropped even lower. It's like all we've seen since 2008 is rates going down. So now that they're going up, it's a little bit of a sticker shock, but I feel like people are slowly going to start adjusting because this isn't the norm, but, we're pretty close to it. 1% definitely isn't normal.
Okay. Well, thanks for that insight. It's always on everybody's mind. So now if we can just sort of switch our conversation a little bit to actually the mortgage world. And if you can tell us a little bit about what the difference is between the services of a mortgage broker and those of a mortgage specialist.
Yeah. So a mortgage specialist typically works for one specific lender. So for example, if you go to TD and you're looking for a TD mortgage, you'll deal with one of their mortgage reps. Not a lot of options there, but if you're very set on that lender, that's a good way to go about it. Now, a mortgage broker is a little bit more of an expert because what we do is we deal with over 40 different lenders, sometimes in the case of 50 or 60, including private lenders, chartered banks, credit unions, and what's called monoline lenders. So these are mortgage only companies. By having that full range of lenders available, you're opening the door to more options, more products, policies, stuff that could better suit the client's needs. We'll sort of break down all of the options across the lender landscape, taking away the shopping out of it for them, making the process nice and easy, and hopefully placing them with the lender of their choice.
Okay, so you are the mortgage broker who's able to provide lenders from across the board, right? Just to
Correct.
Okay.
Yeah. If I was to simplify it in one sentence, it's just we could provide options.
Okay. And so is there a fee that is associated with using a mortgage broker?
So it really depends on the mortgage type, but generally speaking, I would say no. If you deal with the chartered banks, the credit unions, or the monoline lenders, brokers are fairly compensated by bringing your business to that specific lender. So there typically are no broker fees and there are no lender fees. Where you might run into broker fees is when you're dealing with more non-traditional mortgage types, things like private mortgages, things that don't fit the institutional lending criteria. For example, there might not be any income, there might be tons of equity, terrible credit. In those cases, there might be some fees.
Okay. And in terms of utilizing a mortgage broker, what areas do you yourself serve?
Yeah, so Garland Mortgages is located in Mississauga, Ontario. So Ontario, I'd say, is our primary lending space, but we're actually licensed through our brokerage to work across Canada. The simpler provinces obviously being Alberta, BC, and the more difficult ones being, Quebec. But we do have access to lenders across the landscape.
Right. So if somebody wanted to buy a second property in Calgary or something, you could assist them with that mortgage from here, correct?
Correct. Exactly. What technically happens is we reach out to another person within the brokerage from Calgary, from Alberta. And I would do the legwork on this end, but I push the paperwork through them.
There are so many types of mortgages out there in the marketplace. Can you tell us a little bit about the difference between a conventional mortgage and a high ratio mortgage?
Absolutely. So a conventional mortgage is when you put 20% down or more. Purchase price does not matter for a conventional mortgage, and you're able to go up to a 30-year amortization. When I say amortization, what I'm speaking to is the life of the loan. So how long it would take you to pay off that mortgage, assuming you just renewed every time your term was done. A high ratio mortgage is when you put 20% down or less. These are back-end insured by one of the three insurers in Canada. The bigger name is CMHC, but there's also Sagen and Canada Guarantee. If you put less than 20% down, surprising enough, you get the best rates possible across the landscape because these mortgages are so safe for lenders because they're back-end insured. But there are some caveats being you have to pay an insurer premium, as well as your amortization is capped at 25 years. And the smaller the life of that loan is, the bigger your payment is going to be. So in some cases, if you can get to the 20% down, take a 30-year amortization, but your rate's higher, or you put less than 20% down, take a lower amortization, and your rate's lower, the payment's almost the same.
Okay. And you kept using the word back end. So can you describe to our listeners what back end means?
Absolutely. So when you buy a high ratio, when you obtain a high ratio mortgage, you're getting what's called default insurance. Now that insurance doesn't protect you. It actually protects the lender from default. So if anything were to happen and you weren't able to keep up your payments and that mortgage went into arrears and, eventually the lender had to call the mortgage, CMHC or whoever your insurer is will actually end up paying the lender. And because it's insured in that manner, it's safe to the lender. There's virtually no risk to them. And so they're able to offer you some better rates.
Okay, great. Thanks for clearing that up. Now, we're also hearing of different types of mortgages in the marketplace. And we hear, we see commercials on reverse mortgages. I have people that are self-employed that are wondering if they can get a mortgage, people that are new to the country, if they're qualified. So can you talk a little bit about some of the different types of mortgages that are available to buyers?
Absolutely. So aside from conventional and insured, the buckets really break down to, maybe 10 or 15 different types of mortgages. But some of the big ones we've been seeing lately, especially in 2021, with the rise of housing prices, are equity takeout mortgages. So if you have a ton of equity in your property, there are some lenders who will actually lend to you based on the equity in your home, not looking so much at the income and credit scores. We also do, reverse mortgages. So if you're over the age of 60 and you'd like to take out some equity in your home to basically stay in your home and income, is minimal to none, there are some options for you there as well. Refinances are a different type of mortgages as well. If you ever need to debt consolidate, take out some equity of your home for whatever reason, maybe a car, renovation, weddings, so on and so forth. Those options are available too. And then for self-employed borrowers, stated income. So what that basically means is, most self-employed borrowers aren't claiming exactly what they earn. They're trying to circumvent taxable income. Their business might generate $1 million a year, but on paper, they're only showing $40,000 in income. For those borrowers, there are some specific programs where we would actually look at your business bank statements rather than your T1 generals and your notice of assessments or your tax documents to determine what the usable income is. Those documents truly would tell the true story.
Right. So basically what you're saying is that there are options and you as a mortgage broker can have a conversation with people, I guess, to see what their situation is. And then based on that situation, you could offer them, some different alternatives that would fit into what they're trying to do. And at the same time, what lenders are willing to provide.
Correct. And that's going back to your comments about, what's the difference between a specialist and a broker. That's the big advantage of the broker is that we have access to all these different types of products. So it's really up to us to find what the best fit is for the client and show them the full range of offerings.
Conversations that I have with buyers as well. Typically we're hoping that when they buy a house, it's for long term, but sometimes it may not be. So I have clients that will buy a property for their kids while they're in university for a few years. They'll rent out some of the rooms. And then when their child finishes university, they may not want to keep that property and they may want to sell it. So basically, when they're looking for a mortgage, their options may be different because they may want to exit before 5-year term or things like that. So that's where you would be able to advise them as to not only what mortgage they qualify for, but what they should be looking for in terms of other aspects of the mortgage, correct?
Correct. So, a lot of the time people will come to me and they're like, what's your best rate? Well, then I try to ask them 5 different things about their mortgage. Like, did you know that the average break rate is 36%, or sorry, 66%? 5-year fixed mortgages get broken before the 5-year term is done. So what are your plans? Like, did you know that you can also make prepayment to your mortgage? Like, I see you have a large chunk of savings. Maybe it's better to take that mortgage, use your money somewhere else, but always be able to contribute to your mortgage. And other things like portability, basically moving one mortgage to from one property to another. All these things come into play, and it's important to fully understand the client's needs before putting them into a mortgage, especially because there are some restrictive ones out there that you can't really get out of.
So I know we've been talking about mortgages, and I just was thinking, we know what a mortgage is, but for some of the people that are just getting into the market, do you want to give sort of a definition of what a mortgage is?
Yeah. So in simplest terms, a mortgage is a loan from the bank to help you secure a purchase of a home. That's the bread and butter of it. It doesn't always need to be for a purchase either. If you currently own a home, you might be extending your mortgage for a different reason, but essentially you're getting money from the bank. The difference between the purchase price and your mortgage would be your down payment. So the more you put down, the smaller your mortgage is, and the smaller your loan is. But a mortgage essentially is locked in for a set term. And once that term is done, you have one of 3 options. You could pay off the mortgage in full, you could renew to a new rate, or you could switch to a different lender and test the market, see what kind of other options are out there for you. So it's important to consult with a mortgage broker because especially at the time of renewal, the bank is going to send you back a piece of paperwork and say, this is what you should take. These are the best rates we can offer. And when in fact, that might not be the case. There might be better out there.
So again, I heard another word that you used. So for our listeners, can you let them know what the difference between a term is and an amortization period?
For sure.
A lot of people get those two mixed up as well.
Absolutely. And it can be confusing here. It's not like in the States. So a term is the length of contract you're signing on for that mortgage. So for instance, you first buy a home, you get a 5-year fixed mortgage while your term is 5 years. And then at the end of the 5 years, that's when you make a decision on paying it out, switching it out, or renewing it. And amortization is actually the life of the loan. So your payment is based off of not only the term interest rate, but the amortization in total. So the longer your amortization, the more you're stretching out that loan, and the smaller your payment is going to be.
Right. So I always kind of describe it as the term is the period of time in which the lender will provide you that money at that rate. So maybe you've got, a 5-year rate or a 5-year interest rate at 5 years, or a 5-year interest rate at 3 years. So you'll be given that money for 3 years at 5%, or the other example was 5% for 5 years.
Yeah.
And then the amortization period is, as you said, the length of period in which the mortgage would be paid off. So typically, I think most people start with a 25-year amortization. So if you were to make those constant payments for 25 years, your mortgage would be paid off. But in reality, it doesn't work like that, because during that 25-year period, your rates may go up or they may go down. You may put in lump sum payments, things like that. So, but it's just sort of a ballpark figure of how long it would take to pay off the mortgage, correct?
Exactly. You absolutely nailed that, especially when it comes to term, because your rate is only guaranteed for that term, especially if you go fixed. So at the end of each term, you're kind of signing on to a new contract, but that amortization is also shortening with that term. So if you take a 5-year fix and you start with a 25-year amortization, well, at the end of your 5-year term, you should have 20 years left. And then you sign up for another 5-year term. At the end of that term, you have 15 years left, so on and so forth.
Okay. So in Canada, and we're here in Ontario, how much money do you need in order to buy a home?
That's a great question. So if you're purchasing for less than $1 million, the rule of thumb is 5% of the first 500,000 and then 10% of the balance. So for instance, if you buy for 600,000, the total down payment needed would be 35,000. 25,000 for the first 500,000, or 5% of the first 500,000, and 10% of the last 100,000, or $10,000. Now, if you're buying for over $1 million, so that is 1 million plus, then you need at least 20% down. In some cases, for extremely luxurious properties, there's what's called a sliding scale effect, and you'll have to increase your down payment according to the lender's guidelines. Some lenders care more about it than others, But I would say the general rule of thumb is 20% down over $1 million.
Okay. So having said that, anytime somebody is buying a property worth over $1 million, they're looking at a conventional mortgage then.
100%. That's exactly the terminology, or an uninsurable mortgage.
Okay. Perfect. And in addition to the down payment that the lender is looking for, are they looking to see whether the buyer has any additional funds for closing, or are they not worried about that?
So that's only the case, typically speaking, when you put less than 20% down, because obviously down payment and cash flows are a concern to lenders. They want to make sure you can actually close on the property. They're also going to verify roughly 1.5% of the purchase price for the closing costs. Now, those closing costs might be slightly more or slightly less. That's a general rule of thumb. When you buy for over $1 million, generally speaking, they just want to see the down payment.
Right. And the biggest number in the closing costs would be your land transfer tax. So you can always speak to your realtor based on the purchase price of your home. They can figure out exactly what that land transfer tax would be. And if you're a first-time home buyer, there are government programs to rebate part of the land transfer tax or all of the land transfer tax, depending on your purchase price. So speak to your realtor about that and they can break down those numbers. So in addition to the down payment and your closing costs for land transfer tax, what other additional fees should a buyer have to budget for when they are purchasing a home?
So from the financing perspective, you're going to look at things like legal costs. So your lawyer is going to charge a fee, and typically that fee is inclusive of the title registration costs. So getting your name actually on that property, as well as their own costs, whatever the lawyer charges for their own services. Generally speaking, on purchases, you're looking at about $2,500, give or take, depending on your lawyer. Aside from that, there might be an appraisal cost. So we might actually need, as per the lender's requirements, we might actually need a third-party source to go and vet the property to ensure it's worth what you paid for it. And that cost could range anywhere from, I'd say, $300 to $600, depending on the lender and the appraiser themselves.
Okay. And so that fee is due when by the buyer?
So the appraisal fee is due during the mortgage application process. So once we get your file approved, one of the conditions, what will happen is the lender will say, here are all the things you need to satisfy in order to get your mortgage, one of which is an appraisal. So at that point, we would order the appraisal. Generally speaking, we cover the cost of the appraisal for our clients, but sometimes that cost is passed on to the borrower. And at which point the appraiser would go out, vet the property, do his inspection, come back with a report for the lender. And hopefully the report comes back in at the purchase price.
Yeah, we did have a few bumps in the road there when the market was shifting a little bit in early 2022. Yeah.
Mm-hmm.
And what is the difference between a pre-qualification and a pre-approval? You were talking a little bit about the lender saying, you know, you've been approved, but what is the difference between the pre-qualification and pre-approval? Because it is a big difference for buyers and even for sellers when they're reviewing an offer that comes in. So some clarity on that would be appreciated.
Yeah, no problem. So the way I understand it is a pre-qualification is basically what happens during your discovery call or your first introduction welcome call. What I'm going to do is I'm going to ask the clients, I'm going to vet them, ask them a couple of qualifying questions, things like, what is your income? How long have you been there? What's your down payment? Do you have any debts? And from there, I can kind of gauge a rough number that they'll qualify for. Now, the pre-approval is much more in depth, and this is what people should actually be striving for. Here, you're going to provide all of the income documents requested by your mortgage professional. They'll actually go through, look at the documents, look at the application, check the credit scores, and make sure everything is in order. And from there, they should be able to provide a very fair and accurate assessment of what you'll qualify for. The only variable in that would be the property itself, especially if they haven't seen a property as of yet, because, obviously everything could be good with your income, your credit could be fantastic, but the property might have a giant hole in the roof. No lender is going to want to take that onto their books. So for the most part, pre-qualification is just a very short approval, doesn't really have any merit. pre-approval is much more informative.
Okay. And so when they're pre-approved, you would tell them that based on everything that you've given me and that we've submitted, the lender is willing to loan you X amount of dollars, and we're going to loan it to you at this percentage interest rate. How long does that pre-approval last?
Yeah. So sorry, and thank you for reminding me, but with the pre-approval, we can actually do a rate hold. So that rate hold is good for 120 days. Some lenders are 90 days, some lenders are, 6 months, but for the most part, I would say 4 months. So that means as long as you purchase and you close by that rate expiry date, that rate is guaranteed to you. That's one of the huge advantages, especially in this rising interest rate environment. As rates are going up, you want to make sure you're getting the best possible rates. And you can only do so by starting your pre-approval as soon as the thought of purchasing comes into your head. And of course, if rates go down by the time you actually purchase and close, you're always going to be guaranteed that new lower rate.
It's a conversation that I always have with buyers. It's really important to have your pre-approval in place. And they, often will say, well, I'll get it when it's time. I'm good for the money, but it's got so many advantages to it. So you just went over a few of them. First of all, you know exactly how much money the lender is going to give you. So there's no surprises. You don't find the home of your dreams only to find out you're $50,000 short. You can't come up with that extra 50. Secondly, you get your rate held. It protects you if rates should go up. If rates should decrease, you're also protected because you would now get the new reduced rate plus whatever discount the lender was willing to provide you. And it gives you a strong position at the negotiation table. So think of it yourself. If you were a seller and you had 2 offers come in, and one was with a full pre-approval, and the other one, the buyer said, well, I've talked to my bank, I've been pre-qualified. That's an iffy kind of situation. The pre-approval is in writing. They've done their due diligence. They've had their credit pulls. They've had their income verified, their down payment verified. If you were the seller, which one would you put more merit to? If both offers came in at the same price, which one would you lean towards? Obviously, the one with the pre-approval.
Right.
And which buyer would have a stronger position to negotiate that price? Obviously, the one that comes with a pre-approval. So for so many reasons, it's really important if you're thinking about buying a house, whether it's your first house or whether you're upsizing or downsizing, but you still need financing, it's really important to have that pre-approval in place.
That's why we do it. We want to make sure that when the buyer goes in, they can put their best foot forward. And there's no surprises because, of course, generally speaking, once you get pre-approved, there shouldn't be. It should be a very smooth process from there on out.
Right. And in terms of the buyer, is there a cost for them to get that pre-approval?
Not at all. So we just collect all of the documents, and the pre-approval itself is very fluid. So let's say they can't find anything or they decide to hold off for that 120-day period. No problem at all. We might just update a few income documents and we can restart the process. Very simply.
Right. So you were talking about documents. So speaking of that, what types of things does a buyer need to bring to you if they're looking to have a pre-approval done?
So it's going to be slightly different for everybody, but it falls into one of 2 main categories. If you're an employed individual, that is, you're working for a company, it's generally a letter, a pay stub, and your last 2 years T4 slips. If you're a self-employed individual, that is, you're working for yourself, it's generally going to be 2020 your last 2 years T1 generals, last 2 years notice of assessments, and your statement of accounts showing that you have no taxes owing, as well as your business license, whether that be your articles of incorporation, your master business license, or a partnership agreement. Now, there are some extreme cases where lenders might request more, but that's the bread and butter of it.
Okay. So in addition to verification of income, are they also going to want to verify down payment funds?
Yeah. So during the mortgage approval process, we typically go through the down payment verification. When we get a pre-approval or an application coming in, I generally just want to see screenshots and I want verbal confirmation of, what you've been doing with that money, where that money came from, have it been in your possession for over 90 days. Once we have a purchase in place, then we ask for 3 months bank statements. Sometimes it's only 1 month, depending on the lender. But at that time, we're actually going to verify the transaction. So I'm going to look through and make sure, the money it has done exactly what you said. Because if all of a sudden somebody purchases a home and they're like, oh yeah, like I have the money, no problem, and they can't show me that they actually physically have it in their account or in the pre-approval stage, and then there's all of a sudden a $200,000 deposit in the mortgage approval process, there better be a really good explanation. Otherwise, the lender is going to flag it for sort of anti-money laundering concerns.
Okay. So what happens, because I have a lot of clients as well, they are going to gift their children the down payment. And so they may say, well, I don't want to, put all that money in their account right now when I don't know that they bought something. And their parents may have the money in cash, but often they're taking it out of a line of credit of their own property. So would it be all right for them to then just do a lump sum payment when it's time, or should they still have that money in the account beforehand?
Yeah. So I always tell, we always do it during the mortgage approval process, because like you said, that's a lot of money to be putting into somebody's accounts, especially if there's no purchase in place. And it's even, worse if you're borrowing it from a line of credit, because then you're paying interest on it when the money isn't going to be moving anywhere. You might as well have it in that line of credit, not paying any interest. So during the mortgage process, we'll typically send a lender-specific gift letter. It'll say, okay, the money is coming from this person. They're related as such. This is their address, and this is the amount they're being gifted. And then we'll also we'll match the date on the gift letter with the date of the deposit into the borrower's account. And we try to do it, 15 days before the closing date, just so that there is no, heavy interest cost. Unless, of course, the money's coming from cash, at which point it's almost better to just get it out of the way right at the beginning.
So when you get a pre-approval, you give the buyer something in writing, correct?
Correct. Yeah.
Okay. Does that pre-approval mean that they are 100% guaranteed the funds, or are there things that a buyer should be aware of, even though that they have that pre-approval in hand?
So there's always going to be a 1% chance once you get that pre-approval letter that things will go wrong. And I say 1% very adamantly, because generally speaking, if you're working with a great realtor such as yourself and a good mortgage professional, we're going to make sure we cover our bases during the home search process and the pre-approval process. But there's always things that can go awry. Maybe there was something that happened next door during the purchasing process. Maybe there was a murder or something, not to get super dark, but we actually have seen that in the past. And the lender will say, okay, well, you know what, we're not comfortable lending on this property anymore. Or maybe the home is too close to a commercial railroad track, or it backs onto an airport. Those are all lender specific concerns that we wouldn't really be able to identify until they come up. So the pre-approval is important. It's going to cross your T's and dot most of your I's, but a condition of finance is always helpful at times.
Right. So one of the things, and I was thinking, that was great that you had mentioned those components of it. I was thinking more along the lines of what buyers shouldn't do between the time they buy the house and the time they close the house. So I'm always reminding them that not to go out and, buy all that new furniture for the house if you're putting it all on credit. Don't go and co-sign for your friend because they want to buy a house and you want to help them out. So those kinds of things.
Yeah.
Sometimes we see them do, because they end up affecting their numbers and their application for their own financing.
Exactly. Like all of mortgage qualification comes down to your monthly expenses over your monthly income. And if you're going ahead and taking out more loans during the mortgage process and the lender finds out about it, well, now all of a sudden your monthly expenses have increased, but your monthly income has stayed the same. So you're going to be able to borrow less and less. And that could affect what you have currently approved. So strongly recommend do not go out and co-sign or make any big purchases until after your mortgage closes.
And in terms of a credit score, what are lenders looking for typically in order to be able to give them a loan? Like, what's the minimum and what do they like to see?
Yeah, so the minimum for a high ratio or insured mortgage, that is a mortgage with less than 20% down, the minimum score by CMHC is 600. Now, I have not been able to successfully get one done unless it's been 630 to 650. but generally speaking, lenders want you to be in the 680 range. Credit score is a huge telltale sign of the client's character. And if there's a bunch of missed payments, especially if there's missed mortgage payments, it's almost guaranteed that you're not going to be getting a prime lending product. So, your TD, Scotiabank, RBC kind of mortgages. So for that reason, 680 is a fair score. Hopefully you have good repayment history. You're not missing any payments. You have long credit tenure. That is, you have some credit products that have existed for a long time. So there's a good indication of how you handle your credit, as well as your utilization is fair. You're not borrowing more than you can repay. Specifically, you're keeping your credit products under 65% of the limit. If you have a 10,000 line of credit, you're not going over that 6,500 mark, because once you do, you're actually going to impact your score in a negative way.
Even if they pay off that full amount that month?
So that's a good question. It's only if that balance carries over to the next month and gets reported as such. If you pay your credit products off each and every month, they never get reported to the bureau, and it's always going to show a zero balance every reporting cycle.
Okay. And
balances.
And paying off, does that mean you have to pay, like if your Visa bill was, $6,000, you paid $6,000, or does it work the same even if you paid that minimum balance amount that you have to pay?
So as long as you make the minimum payments, you're staying within your obligation. So, obviously it's ideal you're not paying interest if you don't carry a balance. But if you do have to carry a balance, you want to make sure you're at least making that minimum payment. It's if you're carrying a balance over reporting cycles to the credit agency, where the balance is 65% of the total limit, that's where you're going to start hurting your score.
Right. So how can someone find out what their credit score is?
So there's a number of different ways. The Credit Karma technique, or, Borrowwell, these free websites where you can log in and put your email and your birth date, those won't report accurately. They're missing some certain reporting scores. So your score won't be accurate. It'll give you an indication, but it's never perfect. The best ways to do it is to contact Equifax or TransUnion directly. If you request your credit bureau by mail, it's actually free. Otherwise, you could pay, $11 and get your score pulled, and it doesn't actually affect your score when you do it yourself. The only time it affects your score is when it's an inquiry by a lender or a financial institution. So for instance, you need a cell phone, they're going to check your credit. That's going to impact your score.
And what is considered bruised credit, and what are some of the things that people can do to improve their credit score?
Yeah, so this is one we see often as well. Bruised credit, the worst possible credit score is 300. So that's bottom of the barrel, bankruptcies, missed payments. Unfortunately, there is no mortgage solution for those clients unless they have a ton of equity, which is likely not usually the case. The best credit score is 900. So as long as you're within that 680, really 650 to 900 range, you're going to be getting premium mortgage products across the board. And if you have bruised credit, it's important to identify what's ruining your credit. So for instance, maybe you had a credit card of 20 years and you just closed it down because you thought, oh, I'm never using it. Like, what's the point of having this thing? Well, you just actually killed one of the three factors of your credit score, which is history. So now your credit score will drop. If it's something like utilization, it's important that you get that utilization under control, and you want to stay below 65% of that total limit, because that'll improve your score. And the last one, of course, the most obvious one, is just don't miss payments. And no matter what you do, at least make the minimum payment.
Right. And that was actually what I was trying to remember, was if you've got old credit cards and you're going to do an application and you go, oh, I'll just get rid of these ones, I never use them. But they've, like you said, built a history, and it's a good history. You don't want to close those out.
Correct. Exactly. Yeah. You're almost better just cutting them up and putting them in a drawer.
Okay. So can you explain the difference between a GDS and a TDS, and what it means, and how you as a lender look at those numbers?
Sure. So GDS and TDS are the mortgage parameters that we use to qualify any borrower. The GDS is what's called gross debt servicing ratio. So that's your housing costs, your total monthly housing costs over your total monthly income. Those housing costs include things like mortgage payment, principal and interest, taxes, property taxes, heating costs, and condo or maintenance fees if those are applicable. So all of those things broken down on a monthly basis over your total monthly income will give us your GDS ratio, your gross debt servicing ratio. TDS is your total debt servicing ratio. This is all of your housing costs, the stuff we just talked about, as well as all of your other debts. So if you have things like car payments, credit cards, so on and so forth, all of those things are broken down on a monthly basis, added to your total monthly cost, and divided over your total monthly income. In order to qualify with most lenders, you need to keep your total monthly income to GDS, or your GDS, sorry, at 39% of your total monthly income. That is 39% of your monthly income is going towards your housing costs. For TDS, you need to keep that ratio at 44%. That is 44% of your monthly income going towards housing costs. And every lender is going to do that calculation differently, depending on their specific niche policy. So some lenders will go up to 50-50, 50 GDS, 50 TDS. Some will go 20, 37, 42 GDS, TDS. That's why it's important to know your options.
Right. And that's where a mortgage broker like yourself would be able to figure out which institution they would go further with.
Exactly. Like that's kind of what we see happen from time to time is that somebody will go into a TD bank, TD will qualify the mortgages based on their parameters and tell them they're only qualified for 600. We'll take a look at the file. We'll bring it over to Scotiabank or somewhere else. And Scotiabank will all of a sudden say, no, you can actually get 800,000. It makes a big difference, especially if you're trying to stretch your qualification to look around.
And it's nice to know that you've got that money available should you want it. But I also have a conversation with buyers to let them know that although they've got those TDS numbers figured out by the bank, there's always additional monthly expenses that they need to budget for. So, you're looking at your principal, your interest, your taxes, your car payments, but, you've got other things that, maybe you've got a gym membership or you've got, your kids in sports and all these other monthly expenses. So you don't want to, I don't think you don't want to go to your very maximum. You want to be comfortable with those payments. And so that's why having that pre-approval at the very beginning, knowing what your maximum limit is, just in case you find that house that you're willing to stretch that little bit more, but having that amount of how much the lender is willing to give you, having the amount at which they're willing to loan you the money, we can work out payments, your monthly payments for principal, interest, taxes, utilities, but then we can also take into consideration some of those other monthly expenses that you may have, add all those up and see if you feel comfortable with it. Because at the end of the day, you don't want to be house poor. You want to have a house that you really love and enjoy and that fulfills your needs, but one that doesn't stress you out, if you know what I mean.
For sure. Yeah. No, there's a joke going around in our office, and it's not real. We're not really mortgage brokers. We're more debt managers. It's all about client focus here. And we would never want to, proactively put somebody in a product that they'd be stretched too thin. It's like you said, like there's even home maintenance stuff. That's stuff that's not calculated in your ratios, but it could come up. You might need to replace a roof. And well, there's a huge expense that you got to account for.
So when the lenders are doing their qualifications, do they look at it differently if the buyer is buying a freehold property as opposed to a condo purchase?
They do. So that total monthly cost, housing cost, GDS, that will factor in the condo fees and the maintenance fees. So if there are condo fees and maintenance fees, those need to be accounted for, and that's going to decrease your borrowing capacity. Some lenders will look at 100% of that fee, but most are 50%. So if, let's say, your maintenance fee is $800, they're taking $400 and adding that to your total monthly expense over your total monthly income.
So if you've been pre-approved for, say, $600,000, that pre-approval number is usually based on a freehold property?
It depends. A good agent or mortgage professional will actually break down both options for you. So based on your needs, that initial phone call, they'll say, hey, like I'm interested in buying a condo in the city. Well, in that case, I'm going to make sure I factor in a condo maintenance fee so that, what you're searching for is realistic to what you can afford. Now, if they don't specify, it's like, oh, a condo in the city or a farm out in Bolton, whatever the case may be, then it's our job to provide you with both options so that you're fully aware of what you qualify for.
Okay. So buyers, I know, whenever they're going out to purchase a home, they're always looking for that good deal. And, we've talked a little bit about it, that the first thing they think about is the rate. What rate are you going to give me? But I know, as I'm sure you do, that not all mortgages are created equal. And what one mortgage can provide to what another mortgage can provide may make a big difference for the potential buyer. So what other things other than interest rates should buyers be considering when they're evaluating a mortgage?
So we touched on this slightly earlier, but basically you want to understand your needs or where you are in the life cycle. So for example, if you're a newly engaged couple and you're buying a condo, it might not make sense to lock into a 5-year fix because once you're married, maybe there's kids in the picture, maybe you're going to be looking to upsize. So if you do decide to go fixed, you want to make sure that your mortgage is flexible and that you can port your mortgage. So that is take it from one property to another property. You also want to have a clear understanding of what the penalties are going to be if you need to break that mortgage, because some lenders, they'll have a great sticker price. It'll be 1% lower than anybody else on the market. But then when you go to break the mortgage, it's going to cost you 3% of that mortgage amount. When purchase prices are around 100,000 these days. So let's be real. If you're buying something for $1 million and you have an 800,000 mortgage, well, all of a sudden, 3% of 800,000 is substantial. So definitely things to keep in mind. You want to know your prepayment privileges. Yeah, general like accessibility. Are you going to be able to get a hold of your mortgage lender? Because if they don't send you statements and this, that, the other thing, well, how do you know everything's staying on track? You want to have a really solid understanding of who you're partnering up with.
So that was some really great, insightful information about mortgages. Really appreciate your time, Walid. What one tip can you share with our listeners that they may not be aware of in terms of mortgages and financing that they might find helpful?
I would say nothing is impossible. It just might not happen today. And we see it a lot, but we also see a lot of success stories. People who came to me, 5-6 years ago, damaged credit, and kind of coached them through it. And now they're buying their first condo. It all takes strategizing. It all takes planning. But as long as you're willing to do the work, we're more than happy to assist.
Right. Well, you've been really helpful and very knowledgeable. So thank you so much for your time. Before we leave, how can someone reach out to you if they've got some questions about mortgages?
Yeah, so Garland Mortgage, our office is located here in Mississauga. There's the logo right there. We're right off the Queensway, right by Shoreway Gardens. Otherwise, you can contact me over email at walid@garlandmortgage.ca. My cell phone number, 289-439-5111. I'm always on my phone. Feel free to text me, call me, whatever it likes. Or on social media, Garland Mortgage, both Facebook and Instagram.
Okay, awesome. Thanks so much. And we'll make sure that we put that contact information in show notes. If anybody has any questions, feel free to reach out to either Walid or myself, Evelyn Lopes with the Evelyn Lopes Realty team and iPro Realty. You can reach me direct at evelyn@evelynlopes.com or by phone 905-965-5902. And you can also scan the QR code if you're watching this on video and book a free discovery call with me as well when it's convenient for you. So I think that's a wrap. Thanks so much. And we'll see you at the next call.
Thanks, Evelyn. Have a great